the second stage of our work on the banking industry. We launched the discussion back in last September at Magdalen College, Cambridge. The unanimous feeling amongst all the bankers that we talked to, and we talked to them in complete confidence, they're never quoted, the unanimous feeling was of an embrace of serious root and branch reform. Not one of them, and I try to sometimes goad them into saying, is this all wrong, is it going too far? Not one of them thought that.
As time passes, I think what happened in the crisis gets simpler, as is often the case. And really what happened, I think, was that banks forgot their business models, forgot what the business model of a bank should be, what their purpose in life should be as a corporate entity. This is the responsibility of the banks. The banks can't look to anybody else to sort out their problems. They may be helped by regulators or government or the media or other people, but in the end, the banks screwed up, and it's for the banks to sort themselves out. We do need to do our job for the economy, and this is a big cultural change that's taken place in the banking sector. I think banks, for a number of years, like many other businesses, were saying, we're in it for shareholders, that's all that counts, shareholder value. I do think the banks comprehensively lost their way in customer attitudes over a period of time. You could argue about whether it was 10 years or 20 years, but it certainly happened, and customers were looked at as people to make money out of rather than people to deliver a service to. We have 126,000 employees. This year, every one of those employees will go through a retraining program where they sit down and discuss our values. Again, this would have been unthinkable a few years ago in any sort of hard-driving business, and certainly a hard-driving bank. We have to be different, we have to behave differently, we have to realise we're part of communities and societies, we have to support SME lending if that's what the economy needs. In the end, banks reflect economies. They tend not to drive economies, but they reflect economies. The economy is successful, the banks are successful. So I think there's a big attitude change taking place. Whether or not those issues should be toughened by further legislation, I think, is an interesting question. My view on this is that banks will repair their reputation by doing the right thing. They won't repair it by PR. PR, you know, or advertising, whatever it is, will play a part. But if you haven't got yourself fixed, if you haven't got yourself sorted out as an industry and the individual organisations, then it's spitting against the wind.
I think that to grow balance sheets so rapidly over such a short period of time, with so little kind of equity underpinning it, you simply have to say that bank managements and the shareholders in banks actually made a monumental mistake over their business model. And they made a monumental mistake over their business model, in my view, because that was part of an intellectual mistake, that actually self-organizing actors in self-organizing free markets with maximal amounts of information basically didn't make mistakes.
I don't see the history of the past 10 or 20 years as unfettered market forces being allowed to let rip. I think what we saw was a weird mix of market forces and massive government intervention which rigged these markets. And I think the markets were massively rigged starting especially in the late 90s when the LCTM hedge fund was bailed out, then when when there was massive intervention after the dot-com bubble, which I think also was fueled by full monetary policy and so on. And what you really had was a sort of warped version of the markets. There was no plan B. There was no resolution mechanisms in case one of these large banks goes bust.
And actually the reason why democracy and capitalism go hand in hand is you do need public agency, and public agency has to be accountable, hence democracy. And actually a worldview in which it just says it's all about discovery, and if you go wildly off the rails like we did in 2008, a consequence which we could be living with for another 5 years, and scarring businesses, people's lives, is just, you know, that's not, I don't think, a proposition that makes, you know, capitalism legitimate.
And I think the most important reform has to be macroeconomic reform, which we've not had. We've basically had no change whatsoever there. You're still having central banks who think they're the masters of the universe and who can pump primary economies and so on. I think that's terrible.
I can't imagine that actually that in a democracy you could ever permit savers their deposits to be at risk from mistakes of which actually they cannot expect to have any kind of corrective mechanism. And that demands actually a regulatory response. That demands actually that, you know, that there is a dialogue at the very least between the banking sector and, you know, public authorities.
people shouldn't be bailed out, and no one should think they can ever be bailed out. And I think that's a fundamental point. You need to return the discipline of capitalism to capitalism. If you don't have capitalism in banking, you have massively distorted outcomes, and you have taxpayers bailing people out.
There's not yet an intellectual and policy framework that will support both the macro questions that have to be answered, and actually I think the business model questions have to be answered for banks. So, you know, I think it's still very much work in progress, and unless we kind of own the fact of what went wrong in the past, I think we're unlikely to make much progress in the future.
Why do we still have this bonus structure? Why not a company-wide profit share? Why are bonuses paid when the bank overall makes a loss? The fact that bonuses are linked to the performance of individual divisions and can be paid when the bank is making a loss as a whole is another factor that alienates the public.
According to this poll, 69% say they want to see capping of bonuses and pay. And you know what? Actually, the bonus cap is coming in. I agree the industry didn't like it, the government didn't like it, but the bonus cap at EU level is coming in.
We are not a Me Too. We have an oligopoly of Me Toos. We do not need more Me Toos in this industry. What we need is competition. What we need is to give customers choice so they can make their own decisions about where they want to put their money.
Well, the worry is, with bonuses, with very large remuneration packages, what you're doing is you're displacing the extrinsic motivations because I care about it. Rather the intrinsic motivations, you're replacing it with an extrinsic motivation so that really the reason I'm doing this is because it's in my interest.
And I think there is, 5 years on from the crisis, bafflement that in the outside world's opinion so little has been done, notwithstanding what Anthony said about the levels of pay, even if more of the pay is deferred and subject to clawback and so on.
It's not so much the amount of pay, but actually making sure that people are paid for doing what you want them to do, as it were, making sure that they're not, the whole system isn't rigged. So the problem with, in a more broader industry sense, with FTSE 100 director pay is when you have remuneration committees where they're all scratching each other's backs and giving each other higher pay, which just inflates pay without proper governance.
Deborah.
Yeah.
I think one of the interesting findings from the SALTS review into Barclays was that pay was used as a primary tool to influence behaviour, and I think this is one of the problems in banks is a slight dereliction of duty by managers in that managing people isn't always about pay, and yet that's the way it has been used.
Banking's an industry that's just shot through with trust relationships. So the banks facing clients and also facing society. And the moment you have those kind of fiduciary relationships, it's really important that there's transparency about what the motivation is that people are seeking after. And the worry is if people are seeking after money, if that's the first thing, the moment the incentives get out of line, and at some point they will, that's the point when the trust breaks down.
I think the industry, though, needs to take a long, hard look at itself still. You know, we're being hit by the trust issues too much, the LIBOR, the hedging, the things like that. We just need to flush them out because we can't move on while these things keep coming out. And it damages the whole industry and it damages our competitive position because while those things keep coming out, you can't have a balanced discussion, which means we'll always be pushed too far.
But on the particular point of trust that you raised, it should be a competitive advantage, and that is a problem. The reputation for London has been hit by the LIBOR scandal and other scandals. There's no doubt about it, and you can just read some of the speeches of American politicians, etc., to realise that. But London has, for the last couple of centuries, traded on being a trustworthy place with integrity to do business. It was part of what helped it build up as a global financial centre, and we need to get that reputation back.